Greetings, we are going to do another CrashWatch video now because maybe this time the overdue correction in the stock market, the S&P 500, is about to manifest. But we've thought that before. In fact, as you can see over here on this 5-year chart for the S&P 500, we had a nice head and shoulders pattern happen and we had somewhat of a correction, and some could say that was it, but this is still a stock market level way higher than 2018-19, which is not some recession or anything. That was also a robust period. If you look at the stock market levels relative to 2018 and 17, then it's even higher still. Now, what is the median? We don't know. Maybe things are just correcting up to where they should have been due to the 2000s being depressed, but I don't think that's the case. I still think this is considerably above trend line, unless the atom is even more true than I have been saying and technology has shifted into a permanently higher gear. I don't think that is quite the case because we still have to have a proper correction because of many classical indicators that normally signal a correction and because we are in a tightening phase of money printing. Unless there is a new type of money printing being done, which is something I will also talk about in other videos on this channel. So what are the factors pressuring a correction? 1, cumulative high mortgage rates. As I speak about in many videos on this channel pertaining to the housing crash, mortgage rates are quite high, certainly higher than they were during COVID-19, and the longer they stay high, the more that begins to pressure home prices and housing demand and cause people to lose home equity, which is very negative for the economy on many levels: consumer confidence, home building, home construction, net worth, things like that. Then, there does appear to be a concerted campaign among the governments of the world and the central banks to force oil prices higher in order to destroy demand for oil. And this goes back to my X points thesis about how oil has a finite lifespan because of technological forces displacing oil demand when the price is too high, as you can see in this tag up here in this upper right hand corner. That goes back to a prediction I made in early 2011, so more than 12 years ago, and that prediction turned out to be correct because $70 is the pivot point for oil, and that $70 price does not rise with inflation. It was $70 in 2011, it is $70 even now. And then the third factor, in the United States at least, student loans are something that has become a big problem in terms of the wealth and well-being of young people who have taken on too much college debt, university debt, because the costs of universities in the United States has risen very highly, even though the quality of education delivered is getting lower and lower. This is part of this education institutional bubble because the quality of online learning is becoming better and better, but these institutions are charging more and more and tacking on debt to the younger generation. Student loan debt is over $1 trillion in the US, and there was a payment holiday for quite some time, but now that holiday is ending and people who are not making loan payments will begin to make loan payments, and these are also people who cannot buy houses because they still have student loans that they have to pay down, so this further reduces demand for housing. So cumulative high mortgage rates, concerted campaign to raise oil prices in order to create demand destruction of oil, and student loan payments soon to resume in October itself are all factors against the S&P 500. And will this get us down to the crash that we have been anticipating, down to the low 3,000s, or since more time has passed, the low mid 3,000s maybe? But we shall see. That would still be about a 20 to 23% correction from here. Now we go back to the S&P 500 chart. As you can see here, quantitative easing, money printing, causes this wealth effect with surprisingly little inflation. The amount of money printing that was done relative to the low amount of inflation, going back to the beginning of quantitative easing in 2009, really does reveal this new dimension of the economy. And when you have an artificial intelligence boom and a company like Nvidia, which may have been only $200 billion in market capitalization here, but now is $1,200 billion, $1.2 trillion, then you have a proof point of the atom and how money printing is ingested by technology to produce more technology. There was not a $1 trillion market cap company until 2019, when Apple crossed the $1 trillion mark. Now there's 7 or 8. And while the roster of that 7 or 8 may have some turnover, that total number is not really going down. It will go down temporarily if there is a correction, but then as the market recovers, we will get 7 or 8 or more. And in the 2030s, I'm quite certain that there will be 50, 100, 200 such trillion-dollar companies as we progress through that decade, just under the first principles of technology and economics, because quantitative easing has to be permanent, and technology is what ingests quantitative easing, money printing, to produce more technology and thus more deflation, demanding more money printing. But as far as the stock market, we will keep a closer eye on that as this unfolds. Is this it? Is this what will take us down from this 42.73 level we are seeing right now down to about here, the low 3000s, which is still what was a record high in late 2019? And that's not even counting the dividends of the S&P 500. The returns are higher than this chart because of dividends. So let's see what happens in the next 30 days. Thanks for watching.